Economists and financial gurus collide. Are you following financial advice that's actually hurting you? Discover the money secrets they don't want you to know from the best-selling finance books. Okay, so you're trying to get your financial life in order, right? You read all these books, you listen to the experts. But sometimes it feels like everyone's saying something different. Well, get this, even top economists disagree with the super popular finance gurus. Let's break down some really important eye-opening secrets. It's going to make things a lot clearer and help you build serious financial security. First off, how should you actually save money? Economists sometimes say if you're young with a good job ahead, spend a little more now, you'll make more later and can pay it back then. They call it consumption smoothing. Enjoy life a bit. But those finance gurus, they're all about saving a set amount from every paycheck. It builds financial discipline, they say, and you get that sweet compound interest working for you earlier. It's like setting a really important wealth building habit. Honestly, which is better is a tough call, maybe a bit of both. Now, budgeting, everyone's favorite task. Economists think of money as money, dollars are fungible. And you don't need to earmark specific money for this and that sounds overly complicated. However, a lot of these popular finance books suggest making mental accounts. Think vacation money versus new car money. It helps some people stay focused, especially if those individuals are facing trouble with debt management. Here's a big one: how much should you put in stocks? Financial planners and economists usually agree when you're young, go heavy on the stocks for financial gains, but as you get older and retirement gets closer, shift towards safer investments such as bonds. Why, well, gurus will tell you stocks are riskier in the short term. However, stocks tend to earn more over a long period. This isn't always true though. Economists have a slightly different take to them. Your job and future income are like a really safe bond. It balances out the risk of your stocks early on. As you near retirement, you have less time to earn wages. So you need to lower your portfolio's risk profile with bonds. Should you only invest in stocks that pay dividends? Some people get really excited about those dividend checks, but economists say that's usually not a smart idea. Dividends get taxed, and it reduces the growth potential to some degree. They argue if you need the money from your investments, sell a few shares. It is far better in terms of financial advice. What about investing overseas? Should you only stick to your home country? Diversification is often thrown about. Economic theory suggests a global portfolio is less risky. However, lots of folks are more comfy investing in companies they know. This is termed home bias. Here's one where everyone's pretty much on the same page. Index funds beat actively managed funds. Those fancy fund managers charge a lot, and statistically, they just don't do better than a simple index fund. Save your money and go with the index fund for intelligent decisions. So who's really correct? The economists with their spreadsheets or the gurus with their motivational talks? James Choi, the guy who wrote that big study, said economists know how things should work. However, that doesn't mean humans act that way due to our frailties. All those financial empowerment tips from gurus might actually be more helpful for real people facing challenges with saving or credit score. It's like dieting, he says. The perfect diet doesn't matter if you can't stick to it in this way. That perfect theoretical answer doesn't matter if you can't put it to use in your own life, or if you simply find it ineffective. Speaking of wealth, let's briefly discuss estate planning, which can sound intimidating, but it is important. It's not just for rich people. Think of it as preparing for any financial obligations your loved one will inherit after you die. A will allows you to decide what happens to your children, money, properties, and pets. A key part is naming someone you trust to manage it all. Estate planning is also making smart choices for taxes. There are steps and strategies that can greatly help. For example, smart gifting. Robert Kiyosaki's Rich Dad, Poor Dad offers helpful ways to think about money. An asset puts money in your pocket, and a liability takes it out. His main point is simple: use assets to buy liabilities. Instead of spending your paycheck on that want, use your money to buy income-generating assets that could then pay for that liability. An example would be rental properties, where income can help pay for fun liabilities such as boats or ATVs. Ultimately, what's most important is finding a system that aligns with your financial goals, whether it's budgeting or investing in high-yield savings accounts to save money. Saving tips, it's about what you can consistently stick to and apply to your financial well-being for long-term investment for financial success. However, this video didn't fully explore advanced tax planning or alternative investments like real estate funds for wealth accumulation, which may be crucial for long-term gains for those seeking financial independence. Tell us if these are video ideas you might like in the comments, and to keep learning new ways to unlock finance, share this video with others and subscribe.